welcome to Global Mantra, the show that brings to you prominent fund managers from the City of London and gets their views on the global market situation. Joining me on the show today is Michael Parr, who's the investment strategist at Investec Asset Management. Michael, it's great to have you on the show. Thanks very much for taking out the time.
Thank you for inviting me.
Okay, I was going through your views and your investment advice comes out as pretty clear and sharp. You're looking at investing in Australia, Asia and the Middle East because Asia is where the global economy's growth will occur, something that we all have been talking about for a while Australia and the Middle East have the resources Asia needs. Don't invest in the European region and the US.
That's absolutely right. I see the global locomotive as essentially being centered on Asia, and the two most important locomotives are China and India. The way that I look at the Middle East, Australia, Latin America, Africa, is that they are coal trucks providing the resources that these two core locomotives need in order to continue growing at the rates they have been growing at. And I regard them as relatively secure in their position in the world today, especially when you compare them to the problems that persist in Europe and the United States and Japan.
Right, but given the risks that we are surrounded by right now, what are the kind of return expectations that one should be looking at these markets with?
I think last year we saw a situation where emerging markets underperformed developed markets, though we're talking equities here, of course. Both asset classes actually declined, so it was a relative underperformance in a declining market. I think this year we've already seen signs that emerging markets again are outperforming. They've got valuation advantages, they've got growth advantages, they've got demographic advantages. Indeed, I'm beginning to wonder whether the idea that emerging markets, quote unquote, should trade at a discount to developed markets is a logical concept that we should continue believing in. I do think this year you will probably see a sort of a stuttery start through till about the end of the second quarter. I think China, especially post the Chinese New Year, is going to indicate that it's on an easing bias, but it's not going to be aggressive easing. It's going to be a very gradual easing bias, and they will give a few hints here and there. Reserve ratios might come down, probably not interest rates until around June. You may see them allowing more lending by the banks. Essentially what they're doing is starting to inject a little bit of hot water back into a bath that's got rather cold. It'll take a little time for that hot water to permeate itself out to the extremities, especially the resource-rich countries of the world. But come third quarter, I think you'll probably see the Australias, the Africas, the Latin Americas, the Central Asias, the Gulf states starting to feel better because they feel the hot water coming back. And I think that's when the markets are really going to start rebounding, and rebounding in a thorough way, almost notwithstanding what is happening here in Europe, in the United States or in Japan.
But how would you characterize the start of the new year with the kind of rally that we've seen in emerging markets, including India?
I would say that it's a sort of a false start, but it's giving us a sense of the direction that the year is likely to take. I just still don't think all the right ingredients are in place, so I think we may be getting a little ahead of ourselves. But I like the direction, and I think the direction is justified. I still think that there are a few issues in Europe and possibly in the United States, though probably not in an election year, that will upset sentiment at some point in the next couple of months. But I think eventually we're going to see emerging markets basically get over that, and I think it's going to be critical to watch what China does in the next month or so in order to essentially put in place the preconditions for a sustained rally to take place in the second half of the year.
You expect Europe to be rather boring in terms of the kind of events that may happen over the next few years, and also fairly sideways in its movement.
Yes, I think I do. I think that's probably an optimistic scenario in some respects, because I do think that there will be some accidents along the way, but I think that some of the bigger economies...
But no catastrophes?
Well, if you call Greece leaving the euro a catastrophe, yes, there may even be a catastrophe or two along the way. But I don't think it's going to bring down, for instance, the euro as a concept. I think that the euro will survive through this, though it may be a shrunken currency in the sense that it won't have as many members, but I do think it will survive. But it will have to pay a very heavy price to do so. And part of that is going to be the fiscal austerity which Europe has essentially woken up to now. Part of that is going to be recognizing that growth is probably not going to get up above 2% or so over the next couple of years. Part of that is going to have to be a continuation of the very accommodative monetary policy out there at the moment by not just the Bank of England, which is long-standing, but as just before Christmas, the Euro, the ECB as well, through the LTRO system. We're going to see a lot more accommodation coming through there. I think in the United States, especially in the election year, you're going to see the Fed, and we had some, be very accommodative, and they've indicated they're going to stay in that frame of mind for at least 3 years.
But how would you contrast the performance or what happens in Europe versus what happens in the US in the first half of this year?
I think that conceivably the US might look better, but I am very cautious about the US in the medium term. I think that they are overlooking the problems that they're now building up for themselves by issuing the amount of debt that they're issuing. I mean, during the Bush era, from Bush 1 to Bush 2, we saw long-term debt in the United States double from 4 trillion to 8 trillion. In the mere 4 years of Obama, it's gone from 8 trillion to 16 trillion and will continue rising at least $1 trillion a year for the next few years. And you can't carry that on indefinitely. Eventually, the markets are going to revolt. We have things like negative yields on tips in the United States at the moment. We have pretty much no interest rates in the United States. We have the banks getting pretty much any amount of money that they want from the Fed, and there still really isn't creating a particularly robust growth environment. I understand that it's better than it was, but job creation is still not at a rate, for instance, that's absorbing new job entrants into the market. So we can't get carried away. I think it's the optimism of the last couple of weeks is very much that the patient's still alive and is every now and again moving one or two limbs. The patient is by no means up and running and doing the 100 meters.
So in the near to the medium term, you think there could be heightened volatility on account of the political risk that hangs over on Europe?
I think so, and that's why I think that the recovery that we've seen in the first part of this year and a little bit at the end of last year could yet be interrupted by, for instance, an announcement that Sarkozy didn't even get into the second round of voting in the United States, in the French presidential elections, which is distinctly possible. However, I think, and I'm hesitant to use the expression decoupling, but I think that what China is doing is very much what China wants to do for China. It's obviously taking note of what's happening in the rest of the world, but China's got its own big political changes coming at the later end of this year. And I think we will see China start to ease a little bit, start to take the foot off the brake, start to relax some of the restrictions that it's placed on property, for instance, the property sector in China. And I think this will help emerging markets. I'm still worried about some areas of emerging markets, Eastern Europe, which I think is too dependent on Western Europe, to some extent Mexico, which is still too dependent on the United States, but Latin America, Africa, the vast majority of Asia, and then these 4 countries which I think are going to cross over, which is Australia, which you mentioned, New Zealand, Canada and Norway, all of which are resource rich, may all actually march down a different path.
Is there a clear direction you see in 2012 for the way EM equities, EM debt, the emerging market pack would move? Because there is clearly a lot of political risk that one needs to kind of contest with in this year.
I think that if emerging markets are not at a higher level than they are today by the end of this year, something fairly catastrophic must have happened between now and then.
Okay, and what is the worst case scenario that you're working with?
The worst case scenario that I would work with would probably be 3 or 4 countries are forced to leave the Eurozone. Now, we tend to focus on Greece leaving the Eurozone without recognizing that the real consequences of Greece leaving the Eurozone would be the effects that would have on some of the key banks in central part of Europe, in France, in Germany, which would probably need to be recapitalized by the state. So some of the leading French banks in this very, very dark scenario that I'm painting for you would have had to have been nationalized or partially nationalized by their governments.
And what would be the impact of such an event on fund flows then?
It would slow things up. And one of the things that I saw a McKinsey study recently which showed us that 80% of the world's mobilized savings still exist in the West, only 20% are now in the rest. By contrast, 80% of the growth over the next decade is going to come from the rest and only 20% from the West. So you have this mismatch between savings/investment on one hand and growth on the other hand. An obvious question arises as to what degree are those savings going to be invested in the growth of the rest of the world. And we at Investec Asset Management, one of our jobs is to try and intermediate those sorts of flows. So it's incredibly important for us to try and estimate those levels of flows. If there is something that catastrophic happens in the West, you could see those savings basically go on into an extreme risk-off mode. Treasuries, US dollar, and the usual stuff. If there is a muddle-through year, with a few incidents here and there, but they're broadly speaking contained, I think you will probably see by the second half the warm water that China's been putting into the bath starting to be felt by other parts of the emerging world, and you will see the markets rise in a more sustainable way. But I still think it's probably too early to say that what's happening now is that process.
What is the kind of risk-return expectation that one should be looking at emerging markets with?
I think you can essentially say that emerging markets are going to give you better risk-adjusted returns. And one of the things that immediately throws a spotlight on is the growth of emerging market debt as an asset class, which people are now starting to move into on the basis that they feel in the past they may have overestimated the risk associated with local currency debt in emerging markets, and especially underestimated the risk associated with local currency debt in developed markets. So the yield sweetener that you get by swapping developed for emerging is quite substantial, and you're not necessarily taking on a whole lot of extra risk by doing so. There is an additional dimension which people have started to realize as well, and that is, although there is a bit of an ebb and flow tide here, that over the longer period of time, the emerging markets, or the currencies of the emerging markets, are generally speaking strengthening against those of the so-called developed world. So you're getting two things. You're getting the yield sweetener and you're getting the currency effect. In fact, until recently, you were actually getting more out of currency than you were out of yield, but both of them together were giving you sometimes over 10% decent returns. So right now, as we speak, is emerging market sovereign debt a buy for you? Local currency, yes it is. Absolutely. And indeed, I think that as investors in the West become more comfortable with the whole concept of emerging markets, it's going to be the most important stepping stone for them into the world of emerging markets, because it's a sort of calculation that's easier for many of them to make. Once you have to go into equities, then it's a full-on emerging market risk that you're taking on board. When you're going into debt or fixed income, it's a sort of halfway house. And I think a lot of people will acclimatize themselves to emerging markets by first going to local currency emerging markets. Indian government bonds, are they an attractive opportunity? I think so, because I think the downside risk now on the currency, which is always the worst side of the loss when you lose the currency, the yield is still there, no problem, and the downside on the rupee has to be extraordinarily limited. So actually, I think bonds are far more attractive, Indian bonds, than in the immediate sense equities might be. Are you taking a view on the rupee and how much it can appreciate from here? No, and I think that the government themselves, or the central bank, is probably mindful of the fact that they possibly don't want it to appreciate as much as it might otherwise do. I don't think they want to restore the status quo ante. There is this issue of a rather large current account deficit that always hangs over India, and if they could somehow gain a little bit of competitiveness without unleashing inflation as a result of the movement of the currency, they would have achieved something that everybody in the world is trying to achieve at the moment, and they would have done it without trying too hard. So you think the currency would pretty much stay around these levels, 49.50, those? Yes, or maybe a little bit of more rebound, but I don't think they want it to go back up to where it was before. What about cash management, at the fund level? Do you sense that there is pressure right now, given what happened in the latter half of 2011, for funds to deploy cash, pressure coming in, of course, from investors? Well, the tradition is that please don't carry cash on the balance sheet more than you absolutely need. However, I think Western investors have become much more relaxed with the idea, given what's happened in the West over the last couple of years, that fund managers might actually carry slightly higher levels of cash on their balance sheets. Of course, this is a great position to be in if markets do start to rebound as well. So most of the fund managers would turn around to their investors and saying, we're just making sure that as and when the rebound comes, we've got firepower to exploit it.
Do you expect that over the next 1 or 2 years, it would be, for the market, range bound with intermediate rallies, or will it be, perhaps the resurgence of a new bull market? I
think we will see a continued rise in the market, but I do think there will be periods of pullback. My favorite image for emerging markets generally in terms of price movements over a medium term is that of what I call a rising sawtooth, SAW tooth. It has this sort of effect, and it makes life very difficult for those people who are traders, but if you're confident and have a medium term, what I call strategic investor outlook, you just basically ride these pullbacks, maybe take a little bit at the top of each of them. And
how do you do that? How do you account for volatility?
Extremely difficult. And it's often a case that particularly you might get the top right, but you rarely get the bottom right, and so you're left with cash when the market has started to rebound 15 or 20%.
A lot of funds are setting up or indulging in long-short strategies in emerging markets.
I would read it from the perspective that emerging markets are starting to graduate into being fully fledged markets, and it's quite difficult in thinly traded markets to have long-short strategies. But once depth starts to come into those markets, once liquidity starts to come into those markets, operating long-short strategy is something that you can do, and if you're good, you can do it successfully. So in a way, it's a sign of success that long-short strategies are now coming to emerging markets.